Hey, this is In Your Best Interest. I'm Philipp Müller. Today, I'm joined by Robin Tsui. He's the Vice President at State Street SPDR ETFs and is the APAC Gold Strategist. I'm also joined by Freddy Lim, co-founder and Chief Investment Officer at StashAway. They're both here on this episode to discuss how to invest with gold. We covered the history of gold as an asset class, why central banks are consistently increasing their gold reserves, how you can diversify your portfolio by including gold, and the pros and cons of investing in gold. I hope you enjoy it, and if you do, be sure to subscribe and consider leaving us a review and sharing it with your friends.
Welcome back, everyone, for another episode of In Your Best Interest by StashAway. We have a super exciting topic today. We're going to be talking about gold. This is a topic that many requested, many people are interested in, especially now in 2020 with, global stock markets having some volatile times. Gold being seen traditionally as a safe haven becomes quite the interesting topic to talk about. And I am super excited to have two guests on the show today that are very well versed in when it comes to gold. We have, on one hand, we have our Chief Investment Officer from StashAway, Freddy Lim, with us again. Hey, Freddy.
Hi, morning.
And as we all know from episode 1, if you've listened to it, if not, please go back and listen to episode 1. In that one, we kind of interviewed Freddy, and he told us about his relationship with gold and how he, with his first paycheck, he started buying gold every time and slowly built up his gold exposure, and that was usually physical gold that he was buying. So if you haven't listened to that, go back to that episode. Super interesting insights there from Freddy. And our second guest, and our guest of honor today, is Robin Tsui. He is actually dialing in from Hong Kong. Hey, Robin.
Hi, Philip. Good morning.
It's very good to have you. So to give a quick introduction, but I want to go a little bit more into detail on a few of those intro paragraphs about Robin. Is he's the Vice President of State Street Global Advisors and the APAC Gold Strategist for the global SPDR ETF business. So he really runs the gold part of the ETF business for State Street. So he's been quite influential there. I've seen him speak before on gold. Super interesting always. We have to have a panel before as well. So I think there will be lots to learn for all the listeners on that topic, because even prior to joining State Street, Robin held the position of manager for investment product and research at the World Gold Council. And this is really the market development organization for the entire gold industry, right, Robin?
Yeah, that's correct. I was there for a couple of years.
Yeah, that's so lots of gold knowledge on both sides from an investment standpoint, as an as an investor from Freddy's standpoint, as well as a product specialist on Robin's standpoint. Before we get into the gold topics I want to discuss, I would like to learn a little bit more about your background, Robin. We usually, we talk with our guests a little bit about their background, how they were brought up, what's their relationship with money, and so. What has it been for you when you were, growing up? Was there any mentor or, maybe your parents got you interested in investing because they were saving for you, whatever it may be? What was kind of like your growing up like, and when it came to personal finances, and when did you get first exposed to it?
Yeah, so I grew up in Hong Kong, but as you can tell from my accent, I actually grew up in Australia. So born in Hong Kong, grew up in Australia. So I lived in Australia for about 22 years before I decided to come back to Hong Kong 10 years ago. So how did I get in the industry? So my dad is a lawyer, so he's still a lawyer, but he didn't actually, advise me on anything. So it's more, doing high school in Melbourne, Australia, finishing uni. And, the thoughts of investment and money always interest me. I think being grown up in an Asian family, you always have a tie to money, right? So it's either, the parents would say, become a doctor, a lawyer or accountant, which I did start as an accountant. So I started as an auditor at Ernst & Young in Melbourne. So it wasn't any guidance. It just happened naturally. I wasn't smart enough to get in med school. Probably wasn't smart enough to get into lawyer. Then it just happened. Then I got into commerce info system at Melbourne University, majoring in accounting and finance, and also did a degree in info system, so surrounding website development, IT systems.
So completely separate a little bit, yeah.
yeah, completely separate. And just naturally, I got a summer vacation job at accounting firm, and it just happened from there. So it wasn't really planned to go into finance, but naturally just went into it.
So may I ask you then, what was it? What was how? Because your background is when it comes to finance, it seems to be very geared towards gold, right? So what was the interest, or how did you end up getting into that field of gold in general?
Yep, it's a good question. So when I started my first job was an auditor. So I wasn't covering any gold companies or mining companies. I was auditing financial companies, so the UBS or Australian banks. So when I decided to come back to Hong Kong, I wasn't interested in auditing because the role is quite quite boring, and you have to work late hours. So it wasn't my cup of tea doing accounting. And then I came back to Hong Kong. It was during 2008, during the financial crisis, and I managed to get a job as an equity research analyst in a local security firm in Hong Kong. And then at that time, the boss asked me, which sector would you like to cover? And I said, banks, because, I had some idea auditing banks and are probably most suited to the financial industry. Then he goes, oh, no. It's already a team covering the financial sector. How about mining companies? You're raised in Australia. You should know something about mining.
Of course.
At that time, I have no idea. I only know, BHP and Rio Tinto, but I have no idea about, mining companies, how it works and stuff. But I just said, yeah, I'm into mining. I love gold. At that time, gold was about to shoot up because of the GFC.
Yep.
And then that's how I started as an equity research analyst covering metals and mining. But gold was one of the focus sector in my first 3 years, because during 2008 and 12, that was the sector that was hotting up. So I managed to cover about 6 companies in China that has exposure to gold, plus other metals like copper, aluminium, silver. But gold was my core when I started my first job as an equity research analyst.
And then from there, the next one was already at the World Gold Council then, or was that directly flowing into this one, or did you do something in between?
So I moved to Chinese investment bank to covering more companies over the next few years. And then in 2013, the World Gold Council was setting up the office in Hong Kong. So they approached me to see if I'm interested to join. Yeah. And because I covered gold, I knew the World Gold Council. They are the authority of the gold market. And that was something that was quite interesting because, there's only one World Gold Council in the world. So I thought that would be a unique opportunity just to try, see how it goes. And also just taking a different direction in terms of career. Because I've been, covering, mining companies for the last 4 or 5 years, but just doing something different, going to the World Gold Council, trying to launch more products, gold ETF products, partnering with different entities around the world just to push gold demand globally. I thought that was quite interesting.
Yeah, no, super interesting. And I think a lot of people don't even know about the World Gold Council if they think about gold, right? And having that organization behind it. So I assume then the World Gold Council, is that funded then by gold miners and, gold refiners? Is that correct?
Yes, so they are funded by the gold miners. So their members are the top 20 gold miners in the world. Plus, they partner with State Street, so my current company, on an ETF product.
Yep.
So basically, I guess State Street needed someone to market the product in the firm. So I moved from the World Gold Council to my current firm, State Street Global Advisors, just marketing our gold products in APAC. Yep. So yeah, there was a transition from the World Gold Council to State Street. So I've been here at State Street for 4 years already.
Yeah, well, a long time. Yeah, time flies by. Anyways, I've been saying the same. I'm now 3 years in Singapore, so and it feels like I came here a few months ago. So yeah, time flies indeed. But thanks for the intro. I think super interesting. I think a lot of listeners, even especially also on the younger side, they always like to see. Because when you're in university, me and Freddy discussed this before as well. When you're in university, to make sense of what you want to do later on in life, right, and all the pivoting that happens is quite normal. And I think when you're in university, you have this one set path, or they tell you have to have this one set path. And I agree with you and Freddy's background. All of ours are quite the same. That you start pivoting off, and life works this way, right? It's not always all plannable, but if you work hard, it tends to work out. So thanks for that, Robin. For the topic of gold, I have obviously a bunch of questions. So let's see if we can get through all of them in one episode. But and I'm sure you have a couple of things that you guys want to talk about as well. But how about either one of you, or maybe you both have different opinions, different recollection of this. But let's go a little bit into the history of gold, right? And how it became a means to pay in the early days, and then also a store of value. Because I think especially this year, and you were mentioning the global financial crisis as well, right? Gold is always still seen as a safe haven, right, in global turmoil. And we can maybe go through the history and kind of see why is that still being seen that way.
I think Robin would be a great person to start with this. Robin, would you go ahead first?
Yes, thank you, Freddy. I think gold obviously has a long history. It dates back at least 7,000 years when first humankind was using it as a currency. So throughout the human history, the last 1,000 of years, gold has always been the currency that for payment, for exchange of goods back in the old days. So when investors think about gold nowadays, they are thinking back before in the 1990s or 80s, when gold was the only currency that is acceptable throughout the world. So gold has a really long history. And if we move to in the 90s, the US dollars was actually pegged to gold. So one of the reasons why the US dollar became I guess what we consider as a world currency, because at that time, the US currency can be exchanged for gold. So basically, that gave investors the comfort that if you own a US currency, a note, you can have exposure or get delivery of the gold from banks or the Federal Reserves. And at that time, during the 1940s or 50s, most of the currencies were pegged to the US dollar, because given that the US dollar is pegged to gold, you have the British pound or the Swiss, they are comfortable to pegging the US dollar, given the gold backing that the US dollar receives. So basically, that's one of the story how today people consider US as the gold currency, because it was mainly because of gold. Gold actually pushed or made US as the global currency, given the backing. So cut the long story short, because I can go on forever.
Yeah.
The US government decided to unpeg the gold to the dollar back in the 1970s because there weren't enough gold to back the US currency. So at that time, the US government needed to print more money, like today, to actually, to back the economy, because they were coming from or out of from the Vietnam War, where they need to print money to stimulate the economy. So during the 1970s, gold was officially unpegged to the dollar. And so until 1970s to now, gold became sort of a free floating asset where, investors or moms and dads like us can trade, can buy gold. And believe it or not, before the 1970s, no investors can own gold. So basically, it was illegal to own gold in the US before 1970s. So basically, even though gold is considered as a very old asset class, but throughout the world, we could not trade or buy into gold before 1970s. I think that's one of the important facts, that gold is considered, I think, in the investment world as a new asset, because the history is only 50 years relative to other asset classes. So that's something I think youngsters and people coming to know gold should know about, because that's very important. Gold as a history or as an asset class.
Fantastic. I think Robin essentially summarized the entire history of gold in a very short time.
Yeah, exactly. very concise.
Yeah, but if I just recap for him, so gold started the U.S. as the reserve currency, from what I heard, and leaving gold also started the return to the current banking system, which is based on fiat paper money, which is also fractional, meaning if you have $100 in the banking system, banks in the system only need to hold supposedly say $10 in reserve, and they can lend out the other 90. Hence, money can multiply in the system, right? Because they lend out the 90, somebody else gets the $90, put it back in the banking system. Banks hold another $9, lend out the other 81. The process keeps going, right? So it supported the modern expansion of economies. I think that's just to tie in with what Robin said at the last part.
Yeah, no, totally. And I think when we talk about store of value here, right? Because when the last, since the global financial crisis, ever since, obviously equities have been doing really, really well. Even bonds have been doing really, really well, right? So people were always saying, well, why should I even, have any gold? Maybe now in a digitalized age, gold will not be working as well in the next crisis. So what would you say to these arguments, and how has it played out so far this year for gold and in a portfolio?
Yeah, we have quite a bit of argument, very early days of StashAway. Just to recap, because when we first started, we don't have that much allocations to go. And in December 2017, most of our portfolios went full allocations, i.e. around, a lot of you will see 15% allocations in gold. And a lot of people were asking us like, what is going on? Why do you like gold that much, right? Why the algorithm likes gold that much? And that was when we look at it, was at 1240, right? And recent years has seen gold appreciating regardless of whether the stock market is up, regardless of whether economies are growing or not. It has went up. And then in bad times, it actually goes up further. So this year, it has proven itself as a portfolio insurance. It's a commodity that provides insurance to portfolios. So in a way, it has proven itself as a store of value as well, right? So it has done very well over the years if you give it enough time.
Yeah, and I think this is where a lot of people always, argue with me, and when I tell them, hey, you should have at least some portion of your portfolio in gold, but they're, oh yeah, but it's not paying any dividends, it just sits there, right, and it's not gaining so much. But it's more than that, right? You need it more than just as I know it doesn't pay dividend, but there's more to it and why you should have it, right?
Yeah, exactly. We can go on and on about why we like gold, but before we go on a rampage, it is good to acknowledge that it has proven itself over the years. Day to day, difficult to time the market in gold. But taking a long-term view has been extremely lucrative.
Yeah, exactly. Robin, anything from your end there, or you pretty much agree with Freddy?
Yeah, I agree with Freddy, but I just want to touch up on. I think gold, like it's a very unique asset classes. As Freddy yourself know, that gold is driven by many factors. That's why it has very, very low connections or correlation with other asset classes like bonds and gold. I think one of the beauty of gold is that it has a true nature in terms of it's driven by investment. So during this year, a lot of demand driven by uncertainty. Investors buying the gold because they're uncertain about the environment and how the pandemic will play out in the future. But then gold is also driven by expansion. So don't forget that gold is driven by jewelry. It's driven by jewelry demand in China. It's driven by technology. So computers, like in your iPhone, there's certain types of gold in your iPhone computer that needs gold to do the functions. So if you look at gold, even though during times of uncertainty, the price and demand will go up, but then during times of expansion, it will be driven by jewelry and technology. So that's why you've got to hold gold over the long term, because through different cycles, it will be driven by different demands throughout the sectors. So that's why it makes gold so unique in a way that no other asset class has this function. And on top of that, central banks around the world are buying gold. So you have the central banks of Russia, Turkey, China. They are aggressively buying gold on a yearly basis, which means that they believe gold does play an important role in their financial system.
Yeah, and I don't think not only just central banks, right? You've been, if you listen to the news or if you read, on your Bloomberg, you hear a lot of the big hedge fund managers in the US privately buying gold, as well as coins and everything, because they're all really worried about what the future holds in terms of the free printing of money everywhere, right? And low interest rate environment. So I think that also has probably something to do with that, right?
Well,
yes, exactly.
With the COVID-19 and the massive amount of policy bazookas that we're seeing around the world, right? This concern became even more elevated, and gold actually went up a lot during this whole market crash this year. So from that angle, it not only hedges you for a market crash, it also sort of protects you from the dilution of paper money created by the central bank's policy stimulus, right?
Yeah.
Just to add to that, there's another angle I don't know if Robin would agree. It's a hypothesis. In my opinion, the COVID-19 may open a rift among countries in EU further, right? There's been a lot of dissatisfaction among countries with how their bailout, the rescue packages are coming in, right?
Yeah, they're discussing it right now all over the German news when I keep watching it.
Yeah, and you can't help but wonder. There's always this risk of a few situations where the European Union may change its structure, and it could be the fact that the more developed ones are Germany and France, which actually choose to leave, or the other way, right, where the ones being told not to spend wants to leave, and Brexit already happens. So I think those scenario actually is one of the reasons why a lot of individual countries, central bank, even in Europe, even though they don't have control over their own monetary policy because it's all unified now, but the individual countries are buying gold. They're holding reserves. They're buying it systematically every year. Just to add to Robin's point that central banks are buying gold. It's not just China. It's not just the big countries. There's actually quieter amount of purchases done for the individual countries in EU as well. And I think one of that reason is that one day, if you actually this breakout of the European Union risk materializes, what happens is individual country has to start issuing paper money again for the first time in a long time, right?
Yeah.
And what better ways to first create an anchor effect for your new currency than to have a gold-backed system like the 70s first to start your new paper, right? And once things stabilizes, you can wean yourself off the gold system and go back to a paper money fractional banking, right? So that's how I sort of see the movie play out in a crisis. Call me a skeptic, but I'm a risk manager as well. So
Yeah, no, absolutely. Would you agree with that, Robin, on your end?
Yeah, I totally agree with Freddy. I think there will be a lot of geopolitical risks going forward, given what happened in the last couple of months. I think the money printing is definitely a case where I think our clients are concerned about the currency devaluations in terms of the US or euro, which we have seen this year, right? The currency market is not doing that well. We saw the Aussie, that got hit, and the pound got hit. So if you look at gold as a currency, it's up 13% this year. So it's outperformed most of the major currencies. So I think the beauty of gold, it can't be printed, as we know, and the growth in production is very limited. So I think that's one of the major factors why, in the long run, I think gold will continue its rally, because from a currency perspective, it just can't be printed. As Freddy said, I think there will be more. I think we already seen that for example, in Turkey, they are already issuing bonds using gold as a backing already. So central banks are accumulating gold to issue products to give comfort to investors that the ultimate product is backed by gold. So I think going forward, we might see that upward trend in terms of central banks offering products that's backed by gold. I can see that coming in the next years, hopefully.
Yes, super interesting developments, right? So let's say to change gears here, but we talked about benefits of gold and what the trajectory might be in the future, and especially with private hedge fund managers buying gold, governments stocking up on their gold reserves. Let's say we get the listeners to be interested in gold, right? What would you say? There's a couple of questions I have for them, basically. But first of all, why should every investor have some allocation to gold? I think we covered that a little bit from a more institutional level, but why should an individual investor have some allocation to gold? And to follow up on this, how much gold is enough? Because the way your guys are speaking is, every gold is really, really good, and if long term, even better. There's a lot of utility for it. You can make an investment case in good as well as in bad economic times for gold. Why should I just not have everything in gold if it's that good, right? So maybe those two questions would be super interesting for listeners to get some answers to.
You want to remind me the first one again?
The first one, Freddy, was why should every investor have some allocation to gold?
Okay, let's tackle that first.
Yep.
Let me steal Robin's show for a sec here. I think every investors need more gold than they think. I'm going to go a bit more stronger point on this. A lot of people say you should have 5% of the portfolio in gold. I beg to differ. I think you need as much as 10 to 15 in that. And given the times we're in, where massive amount of policy stimulus that going to dilute the purchasing power of paper money, you need more. And if you are not a US, or if you're not a resident or the citizen of safe haven currencies, you're not from Swiss, you're not from Japan, or even your funding currencies like the US dollars, the risk is even larger for you. Because when you invest internationally outside your home country, like when you invest in assets, you need to also prepare more for the dilution of money, right? Created by this policy stimulus in the US. So if you have a lot of US assets, you get exposed to US dollar, and US dollar is printing, right? And so actually you need a lot more gold to offset the impact of your other assets in US and other countries around the world. So the more you need more gold, in effect. A simple math for you. If $100 invested globally, if the purchasing power of paper money is going to decline by 10% in coming years, your portfolio in real purchasing power term would be worth $90 if you do nothing about it. But so how much gold you need to offset that? If you have $10 out of 100 in gold, and gold rallies 50% in coming years, you only just created a $5 insurance, right? You probably need more gold than you think. It depends on the scenario or the fair value of gold. You need to do quite a bit of homework to determine the right ratio. But in general, you need a lot more gold than you think.
And I think this is a super interesting point of view, I think, because a lot of people, when they, start saving and they, start investing towards their, short, medium, long-term goals, they don't take this helicopter view, right? That one should, and actually, allocate their assets accordingly with that, and with a little bit more thinking behind it. That it's not just, hey, I'm going to buy some equities and some bonds, that there's more to portfolio construction. What about you, Robin? What would you suggest for people to have in terms of allocation to gold? Any set percentage, or what would be a guideline that you like to use, maybe even for you personally?
So we do a lot of research at State Street in terms of what's the optimal allocation to gold. So if you hold a diversified portfolio, so you have 60% equity or 40% bonds, for example, we do encourage holding, as Freddy said, about 2 to 10%, just as a strategic allocation, which means that on a yearly basis, you kind of rebalance to make sure you achieve around the 2 to 10%. So 2 to 10%, I think, depends on your view on gold price or how aggressive you want to be. We have clients that goes above 10%, so 15, 20, 30, 40. But from a strategic long-term allocations, we think 2 to 10%, it's a good starting point. And then you can just adjust on top of that if you think gold price will rally to say 2000 next year. So it really all depends on the investor. So as Freddy, he's so bullish on gold, he's on probably 50% allocation, something like that. But I think somewhere between 2 to 10% it's sufficient, because we do see gold as a kind of like a insurance to your portfolio. So it provides that diversification to your portfolio. As I said before, low correlations, no collectivity to other asset classes. So as a portfolio insurance, I think that amount of gold is sufficient for a typical investor.
Just to clarify, it's 15%, 15. And that's the
15, yes.
Yeah. Just in case.
No. Yeah, exactly, Freddy. It's 15. No, but so that's interesting how you think about it. And I think portfolio insurance we've heard now many times, and I think hopefully this rings a bell with the listeners too, to not just see it as like this huge growth investment, but it gives you more than just that. And I think we talked about this in length already, and hopefully that came across as well for everyone. So let's say, they know now their allocation, they like the history of gold, they are fully on the same page as we are. They want to get some allocation to gold. So what is the best way to get access to it, right? I know there, you can buy physical gold at your bank or at, third parties. You can, you were saying you were covering gold mining companies, so people can also buy gold miners. They can also buy ETFs that are backed by gold. So there's a lot of ways to do it. And to give a quick experience that I had here not too long ago, probably 5, 6, 7 weeks ago, when we're still able to go to the office. I always pass here in Singapore. I pass along the waterfront, and then there is a store. It's called, I think, Bullion Star or something like this, and they sell physical gold bars and coins, right? And you won't believe it, but there were lines out of the door. So a colleague of mine and I, we went on the website actually, and you had to. there was a wait list, so you had to buy it online, then stand in line around the block for 3 hours to then go be able to purchase your gold bars. And if you go on their website now, it's even difficult to buy any gold bars because some of the refiners have shut over in Switzerland, right? Some of the big ones, because they had obviously the same stay-at-home notices as most of all of us are enduring. So, that was just a quick episode. I don't know how it is in Hong Kong for you, Robin, if you've seen the same or in general, but I think getting people to understand how they can access gold and what's the best way for each of them would be super helpful. So I'll leave it up to you maybe to go through a couple of the different ways of getting exposure.
Robin, why don't we go each take turn on each avenue? Let's say in the physicals, what's your typical way of getting access? Just curious about how you do it.
Yeah, and would you even do it?
Yeah, I think as Philip said, there's so many ways to get exposure. In fact, there's at least 7 ways to get exposure to gold: ETFs, funds, physical, futures, mining, etc. But physical gold, I think it depends on what type of investors you are. So usually, the most conservative investor will buy physical gold because literally you can hold a gold and store it in your house, for example. So if I talk to the most conservative investor, they'll prefer to buy the physical gold. But I think one of the cons of that is that obviously you have to go to a shop. So in Singapore right now, you can't go to the shop. The shop is closed. So if you want to get exposure, there could be some limitations just physically going to the shop and buy the gold. And I think another disadvantage is that usually if you buy the gold through a shop, they will charge a premium because they need to pay for the rent and the labor. So it might be that they will charge about 4 to 5% over the spot price of gold. So literally you get hit by the extra premium they charge. And I think one of the difficulties is that where to store the gold. Let's say if you had $2 million worth of gold in the US, and are you comfortable to put that in your house or you put it in the bank? So I think the storage consideration.
And storage is quite interesting now, right? Because especially now, let's say you're stuck for months at a time in one country and you can't really travel to the other country where you may have stored some of that gold, right? That also could potentially put you in a precarious situation if you've been banking on it, right? Having that immediate access.
Yeah, exactly.
Yeah.
Well, Freddy, you like physical gold. I remember from our first conversation, right? You said, hey, from every paycheck since the first one, you started to put, buy a little bit every time, right?
It was more jewelry related.
Yeah.
It was more like a tradition started by my mom first, because Chinese families, we grow up and, when you get to a certain age, your parents will commemorate certain memories and key years of your life with a gold chain, some sort of jewelry. And I remember back in the early days, we get it it's heavier than now. Every piece of gift I got from my mom is a lot heavier than today's jewelry, and so you get more content in gold back then. Right, but we started that tradition. We continue it with my daughter, where every birthday of my daughter, we would buy a small little piece of gold-based jewelry. We did make the mistake of not going for yellow gold. We do go for white gold, and the versions that don't hold its value as well as the pure yellow gold, right? But yeah, that's more sentimental, more jewelry based than an investment. And the spread is humongous, like Robin has mentioned. If you want to trade it, I think I am expecting to lose 10% or even 15% just in bid offer, right?
Well, that's the premium you pay for having it in physically then, right? That's just the inherent downside of that, right?
Yes. So in summary, I prefer a more digital and paper version of investing in gold.
Yeah, no. I think I want to get to the digital or investable one here in a second. But the one thing before we get there is, I think a topic that is quite confusing to a lot of investors is gold miners, right? Because you always hear these stories that, oh, gold price is going up, gold miner stocks are going down, or they're not working as people would assume if they don't do that much research, right? A lot of people think, oh, well, I'll buy these gold miners. They should, their price should go up with gold as well, right? Because they're mining the gold. So maybe, Robin, can you give us a quick overview, since that's something you studied quite a bit in your previous jobs, is how does investing in gold miners differ from investing in gold itself?
Yeah, that's a great question, Philip. So if you invest in physical gold or a gold-backed ETF, you get that one-to-one relationship to gold price. But with gold miners, it gets a bit tricky because even though gold miners, they might produce gold as a business, but there's a lot of consideration to consider that's more important. For example, the extraction costs of the gold, or the production costs of the gold, plus the management, how effective the management is running the company. And also you got to consider where are the mines? Are the mines in Australia that's more environmentally friendly, or are there mines in Africa where the infrastructure could be lagging behind other countries? So it's a lot of factors that you need to consider before you buy into gold miners. And I think one of the most important considerations is that gold miners, they usually have a high relationship with the equity market, which means that they have a very high correlation with the equity market, which means that when there is a equity market downturn, usually gold miners will get a hit. So that they won't provide the insurance or the diversification you need to protect your portfolio. So that's something listeners or the youngsters need to consider, because when you look into mining companies, you got to make sure all the factors I just said are thoroughly researched, and also whether the gold miners, they could be producing other metals as well, copper, silver, platinum. So you got to make sure you know the business quite well, and sometimes it will take a long time to research. And by the time you've done your research, gold price could rally 10% already. So that's something I guess listeners need to consider that.
Yeah, I think the important part here is actually the diversification part, right? So even though you think you're in your mind, you might thought, hey, I get that diversification, the different correlation to equity markets, but you don't, right? And so and that could really backfire to you then if you were planning on using it as that, right? So I think a very, very good point there, Robin.
I would add another point on gold miners, which is the act of mining itself is exploration. As with any exploration, you incur a different kind of risk, right? Like you need to conduct your research on the geology of the area you want to mine if it's new, and what's remaining in reserves, and you need to guess. It's a lot of guesswork and science as well, but you are taking the risk of exploration, right? It's not the same as being just purely invested in gold. Other than the equity risk or the business operation risk, management risk and all, you are also taking the risks of exploring, and you can explore and be wrong about the area you're exploring, and you get nothing, right?
Yeah, absolutely. No, very good point. So, which then brings up to a third way of getting exposure to gold, and that is through either investment funds or nowadays through ETFs. And Freddy, you were saying, so this is something that you like quite a bit in order to get exposure. Maybe you can explain a little bit about that, and then I do have a couple questions, because there is some people saying certain things about the way the ETFs are backed and how they work. But maybe first explain kind of how would that work to get exposure to actual gold through things such as ETFs or investment funds.
Well, I mean, if I look at digitally doing it, and instead to the question, you can buy gold futures, but as in any futures trading, it incurs margin, and you may be tempted to lever. So I prefer a more one-to-one approach, where the buying a good exchange traded funds that tracks gold, has a good history of tracking gold. That to me is actually the most philosophically sound way of investing. And there's a lot of funds out there that tracks gold, but they're not made the same. You do have to do some research as to how the golds are stored and backed, right? So, but there are some ETFs that's actually more levered, right? Like, they don't actually hold the 1-for-1, the amount of gold in the fund. And those funds I also would not recommend, because as with leverage, if gold is down 10% temporarily and you're levered 10 times, you could see massive drawdowns in the fund as well, right? So I would stick with non-leverage 1-for-1 sort of gold, physically backed gold ETFs. That would be the most efficient, cleanest way of doing so.
So with that being said, Freddy, there's obviously a lot of talk, right? And especially probably more so in the doomsday sayer camp, but a lot of people don't really trust even ETFs that have physical backing of gold in vaults across the world, because they said, hey, I can't actually get access to this gold, right? Is it actually there? How much is there? And things like that. Is there anything maybe either one of you can relate to that? So I see, when you read a lot of like news articles, a lot of people are trying to get out of ETFs and buying the physical gold. I'm not saying a lot; it's probably a small percentage, but that's still a discussion that is ongoing in that space, right?
Yeah, I mean, I would say this: some gold ETFs like GLD is a trust. It's set up years ago, before most ETFs even existed. It has a long track record of managing its gold reserve, right? And it's fiscally backed, and I think the golds are stored in the vaults of I think it's HSBC in London. If I'm wrong, it's JP Morgan. One of those. Robin could correct me later. But it's physically backed. Obviously, if it's that big a fund, you can't possibly go through every single gold bar, and But in a way, there's a lot of effort made to standardize the kind of gold that goes in there. It's a trust that's audited, right? So it's good to know whether a fund is audited, whether there's a trust structure, and has a long track record of managing itself, right? And I think GLD is one of those. There's not many gold funds out there that has such long track record of managing it. And it's not just about what is a cheaper fund to buy into, lower expense ratio and all. It's really about the managing history, right, of the fund with relations to its gold reserves.
Robin, do you want to add anything in general through ETFs and how they in invest in gold, or if is that a good way to do it, or any downsides you see there or pros other than what Freddy mentioned?
Yeah, I think Freddy touched up all the good points about ETF. I think the beauty of ETF is that it's simple and it's very cost effective. So basically, if you buy a gold-backed ETF, you are buying into the spot price of gold. So you don't have to pay a large premium over the spot price, and then you can trade through the stock exchange. So basically, if you are locked down at home, you're so bullish on gold, you can just buy You can buy it right now through your phone.
You don't
so
have to stand in
that's
line
easy.
like these people I told you about before.
Yeah, exactly. So it's very good for social distancing. but I think as Freddy said, there's so many ways or so many products that tracks the gold price through ETF space. So you need to do your research on that as well. So basically, are they backed by gold, or they're using gold futures, for example? Because there are some gold futures ETFs in the market. Plus, you got to look at obviously the charges, TR, and one important thing is that you got to look at how liquid the ETF is. So the more liquid in terms of the trading volume on the exchange, the lower the bid-ask spread. The lower bid-ask spread will actually decreases your transaction costs. So even though gold ETF appears to be a simple product, but then you should spend some time looking at different products, looking at the spreads, TR, where the fault is located. As Freddy said, London is the key. London is the gold market for gold. So if the ETF is located in London, the fault is located in London, that will give you some comfort surrounding the gold. And some of the providers do provide the gold list on the website. So if you're not comfortable about whether the gold exists, you can go to the provider's website and you should able to see the gold bar listing on the website.
And I think I've read before, and I think I read before, and I think people don't correct me if I'm wrong. Either one of you, but I did read before that if you, for example, in some of the gold ETFs that are available that are physically backed, if you have a certain position size, you can actually exchange for the physical gold at some point, right? I think it's large sums, obviously, like 100,000 units or shares in that ETF for some of them. But I think that's true, right?
There are available. So some of the bigger ones, they're not available for delivery. But in the last couple of years, we've seen new products coming in which offer delivery. But I think that's more of a gimmick or giving comfort to investors that if something happens, you can redeem. But as you said, the charges are enormous.
And how are you going to get these big sums then around the globe, right? Shipping, storage, exactly.
That's right. So I don't see a lot of cases where people ask for delivery, but obviously it gives them comfort around if they needed to, they can. But the charges are large. They can charge up to 5% of the overall market size of your share in the fund. So it doesn't make sense to take delivery sometimes.
Yeah. So thank you guys for this. I think we're about to wrap it up here, but I have one more question. I think it's a big elephant in the room. Little less noise the last year and a half probably, but certainly the 2 years before that is Bitcoin. And the reason why I bring this up is because when we talked about digitalization and digital ways of getting exposure to gold, and gold being seen as a safe haven and helping with in times of central banks printing money. A lot of people say that the digital gold is actually Bitcoin, right? So I would love to have both of your opinions on, do you see Bitcoin as, so to speak, as that can replace gold in the future as the safe haven, or maybe they both exist in that environment? What are your opinions on that? Because I know a lot of people will want to hear your guys' opinion on this.
I'll let Robin go first because once I go, I can talk on this. So.
Thanks, Freddy. So Bitcoin, I mean, obviously a few years ago or last year, there has been a lot of discussion around whether Bitcoin can be the gold number 2 or version number 2. Because between gold and Bitcoin, there are some similarities in the way that it's not owned by the government. So it's very independent to other money or other asset class controlled by the government or monetary policy, for example. So there are some similarities in the way, but I think given what happened to Bitcoin last year or this year, you can see that the volatility is quite high. You can see, it went up to about 20,000, went dropped down to 8,000. So the volatility is over 100% annualized compared to gold, let's say 15% on average. And then I think one of the key of Bitcoin is that it doesn't have the track record. So Bitcoin's been in existence maybe for 10 years or so, but compare that to gold, 7,000 years. I think a lot of research still needs to be done on Bitcoin, whether it can provide that, diversifications relative to other asset classes. And I think another key is the liquidity. I mean, if you buy gold, you can pretty assured you can sell the gold, anywhere through ETFs or through a store. But Bitcoin, once you buy it, are you sure you know how to sell it? What are the ways to sell it? And to me, I'm not even sure like how to buy or sell Bitcoin and what platforms are there to buy and sell. So I think the liquidity, the lack of track record, and also whether it can provide that diversification, I think that still needs to be some work to do or research upon on Bitcoin.
Right. My turn?
Yes, it's your turn, Freddy. It's your stage now.
No, I'll be cautious. I would say when it comes to cryptocurrencies, it depends on what you're backed by. And the concept of Facebook's Libra is a very interesting one, right? Unlike Bitcoin, because it is backed by reserve currencies, which earns interest and is anchored by something that has close to zero volatility, right? And hence, the resulting currency, like a Libra, is stable. And when it's stable, it will induce confidence to transact in it actively, to buy a pizza. Currently, if you want to buy a pizza with your Bitcoin, before you click the button or know how to sell it so you can buy the pizza, the price has moved a lot, right? The volatility is quite a lot. So that is not a cheap way to purchase, not a cheap way to transact, right? Fundamentally. And it's also important to know that, and what I'm going to say now is not even well known by the technologists in the area because these are financial concepts. You got to also, as an investor, is move beyond the so-called technology. You have to understand the McAfee law. The McAfee law is like a Moore's law of processing chips. It's one of the laws that govern the value, how to value network effects. If a cryptocurrency is not backed by a physical asset, right, then you are utility token. It's just a satisfaction of you sending your coin among yourselves, right, or to transact. And the utility value is based on the value of the network. And the network's value is based on the proportion of number of people of actively using it, the monthly active users in the network, right? And how active they are among themselves. So the value of the network, this concept, McAfee law, can be used to value companies like Amazon, Facebook, and Tencent similarly, because they have very strong marketplaces, communities that buy and sell, right? Seriously, they transact. So if you apply that approach to Bitcoin, you inherently, the McAfee law says that the volatility of cryptocurrency is going to be quite high, because the relationship between the value of the coin is equivalent to the square of the monthly active users. So if you have an increase in monthly active users, it has a square impact positively on the value of the coin. And conversely, if you actually, because it's like thousands of coins now, if somebody competed away demand and users from you, right? It's gone from, say, the Bitcoin network to the Ethereum network. You lose monthly active users. There's a square negative impact on the value of your network, right? So it is by design volatile. It's not going to change. As long as something that's not backed by a physical assets, that's of a low quality nature, and is completely based on utility, you are going to be volatile. So that cannot be gold. Gold is a reserve, is one way. Gold is one of the avenues central banks manage their reserve. It's actually considered a reserve currency. Correct me if I'm wrong, Robin. US dollar is reserve currency, Japanese yen reserve currency. Gold, when central banks are not wanting to get stuck with US dollar reserves, they buy gold. So it's of a very different status. I can keep going on for another 2 days. I'll stop here.
No, I think that's another topic we can dive in future episodes, though, because I think there's a lot of misunderstanding about Bitcoin and things like that we would happily get into in more detail in the future, though. So both of you, to wrap this up, I think the listeners will have gotten some super valuable insights into gold. I did myself, of course. I always learn from both of you whenever we do these things. So thank you very, very much both for your time, to joining us. I think it was a super nice discussion. I'm sure there will be more to come in the future, because we just touched everything here on a high level, but I think in a very, very concise manner. And I think lots of people will have a better understanding and a much nicer and easier way of getting into gold and why they need gold in their portfolios. So thank you both very, very, very much. And with that, I want to say goodbye to you guys. And we will certainly speak again soon.
That's it for the show this week. Thanks for listening. If you like what you heard, subscribe and leave us a review. The reviews really help us, and we love reading your comments as well. In Your Best Interest is hosted by me, Philipp Müller. We're produced by StashAway, and we're mixed by Mo Ramley. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store, so you can start on your financial journey right now.